And the first one, consistent industry growth rate. So hopefully it was clear on the previous slide that not all industries grow at the same rates. And so if you're in an industry like healthcare with a structural tailwind being an aging population in Australia, you're probably likely to get a better multiple than all else being the same than a business that was in a declining market. High margin business, so high margin versus low margin. So if you're in a high margin business in a bad year, you're still going to most likely make money. Whereas a low margin business in a bad year, the risk of actually making a loss is much higher. In which case, the new owner is putting his hand in his pocket to fund that loss. And so, high margin businesses for that reason are valued, more highly. Customer contracts. So this is twofold. So long-term customer contracts, but also diversity in the customer base. So if you've got, customer contracts that are many years long versus 30-day terms, obviously, a buyer's going to pay a higher price for the surety in a longer term contract, and then diversity of the client base is the same concept in that, if you've got all of your earnings coming from one or two key contracts, if they fall away, then the risk to the business is much greater than if, there's quite a diverse, revenue stream from a diverse range of clients. Professionally managed business. So this is simply, not being founder dependent. Growth track record. So in information memorandums, a lot of the time, not all the time, but a lot of the time, you'll see like a forecast for the year, for the next year. And if you're making that same forecast on the basis that it's the same rate as that the company's achieved every year for the last 10 years, it's much more believable from a buyer's perspective than if growth has been flat for 10 years, and then you're saying it's going to be 25% up the next year. And for that reason, history of growth is indicative of a higher sale price. Buyer synergies. So this is probably the key one here on this slide, but I'll cover this in more detail on another page, so I'll just skip that for now. And then obviously sale process, competition, and timing. So it's the aim of a well-run sale process to extract competitive tension, or at least the appearance of competitive tension, which is multiple buyers bidding against one another, and in the process bidding the price higher. And then timing. Sometimes you just get the right buyer at the right time.